I'm Dr. Paul Kosmetatos from the University of Edinburgh, and today I'm going to talk about Scottish banking and the 1772-1773 credit crisis. And in particular, one aspect of this crisis, on which I have written a book, whether this crisis witnessed the birth of last resort lending as part of the containment actions that the authorities undertook to stop the crisis from spreading, or whether this was the golden age of so-called free banking, where such actions were entirely unnecessary. Now, for most modern capital economies, central banks are, broadly speaking, quasi-governmental institutions specifically charged with the regulation of the monetary environment through the monopoly issuance of paper currency and the independent setting of interest rates. Central banks also oversee and regulate the financial sector together with other public agencies. So, for example, in the United States we have the Securities and Exchange Commission. Here in Britain we have the Financial Conduct Authority. Together with treasuries or ministries of finance, central banks also act as agents of crisis containment when the financial system finds itself in one of its periodic difficulties, like most recently 2007-2008. Very often such containment actions center around the role of the central bank as a so-called lender of last resort. Lender of last resort is an agent whose purpose is to provide the ultimate backstop to the financial system by providing emergency liquidity to systemically important financial institutions, which means institutions whose failure might propagate and exacerbate the financial crisis. So this is what happens now. However, this was not how things were in the past. Central banks have evolved over the course of the last few centuries from originally private monopoly institutions chartered by states with the explicit purpose of aiding public finances. In some cases, most notably that of the United States throughout most of the 19th century, such arrangements were in fact explicitly absent, and the private banking system was free to operate without the oversight of a privileged central agent. This is so-called a system of free banking. For the case of Great Britain, it was only with the passage of the Bank Charter Act of 1844, more colloquially known as Peel's Act, and also the Banknotes Scotland Act of 1845, that the Bank of England gained its present-day exclusive monopoly for issuing paper money. And this, in turn, effectively turned it into a recognizable central bank, even though it was still technically a private institution until the end of the Second World War. Until 1844, the Bank of England was a great engine of state, as Adam Smith put it, but in formal terms, it was a private financial institution with some specific characteristics. Its size dwarfed any competitor by orders of magnitude, and the charter that was given to it by the government gave it legal privilege that reinforced this dominance wherever it operated. Yet, despite such dominant position, the further one moved away from London, the more the bank's influence became ever more implicit and indirect. Its monopoly on bank issuance, for example, only held for London and its environs. Outside London, other banks were free to issue their own banknotes. Also, the Bank of England's reluctance to extend conventional private loans left plenty of scope for its smaller rivals to eke out a profitable living. Nowhere was the Bank of England's influence less direct than in Scotland, a country with a separate legal system and with an economy that had only begun to integrate with the rest of the UK after the final defeat of Jacobitism in 1746. The Edinburgh public banks, that is, charter banks, specifically the Bank of Scotland, the Royal Bank of Scotland and the British Linen Bank, never achieved the same dominant statutory and financial position that the Bank of England enjoyed south of the Tweed, though certainly not through any want of trying on their part. The resources were simply too meager to occupy such a position. Scottish bankers outside the chartered system operated outside the provisions of the Bank of England monopoly, which gave it all its privileges, and even the notorious 1720 Bubble Act, which restricted equity capital. So, in practical terms, this meant that the Scots could form multi-partner, co-partnership banks, which brought to bear much more capital than their English counterparts, and also that banknote issuance remained free to all entrants throughout the country, in effect providing interest-free borrowing for banks and also a necessary supplement to the universal dearth of metallic coinage, which was the formal system of currency in the country. Scots bankers were also very innovative, inventing such staples of modern finance as branch banking and cash accounts, which are a form of the modern overdraft, and coming up with a collegiate note exchange system which put some order in their anarchic banknote circulations. This innovative and multipolar system has long exerted a strong attraction to supporters of free banking. These are the people who argue that the banking system should operate without the restraints of a monopoly central bank. Starting with Lawrence White in 1984, this thesis proposes that not only was the decentralized and cooperative Scottish system entirely independent of the influence of its charter banks, Scottish or English, but that it was intrinsically also more robust to financial crisis. The problem with this thesis is the crisis of 1772-1773, which had a disproportionately severe impact in Scotland, highlighted by the collapse of the large and ambitious Ayr Bank, which was the colloquial name for a partnership more officially known as Douglas Heron Co. So this experience has struck a contrarian note to the argument of free bankers that a free banking system like that of Scotland, as they say, there was one there, and that was also more robust to crisis. More recently, free banking supporters like Tyler Beck Goodspeed in his book Legislating Instability have sought an explanation to reconcile this apparent paradox. And they have found the explanation in the supposedly misguided regulatory clampdown that took place a few years before the crisis in the 1760s, highlighted by the Banknotes Act of 1765. This act restricted some of the freedom that Scottish banks had to issue banknotes, especially through the outlawing of the so-called option clause that gave a bank the right to convert its notes to short-term interest-bearing bonds and so avoid having to exchange them for specie whenever it was demanded. The effect of the act, according to Goodspeed, is said to have raised barriers to entry and lowered operating margins to such an extent that the banks had to compensate by raising their asset risk profile, leaving the most aggressive ones, like the Ayr Bank, vulnerable to the shock of the 1772 crisis. Goodspeed does argue very convincingly that the legislation was mainly motivated by a desire to protect the privileges of the Edinburgh public chartered banks, rather than a genuine need to correct financial misbehavior by impecunious and excessively risk-taking bankers, as argued by the traditional narrative to that point, that in fact dates back to Adam Smith. So far so good as far my research is concerned, but Goodspeed then goes further to argue that the free, as he sees it, Scottish banking system was robust enough to ride the crisis of 1772 off without much harm to the wider economy. And the reason for this being that unlimited liability among the many co-partners of the Scottish banks pooled resources in a manner that their English competitors could not match, and in effect acted as a lender of last resort by proxy. Now, my research disputes this thesis on several fronts. Firstly, the facts are that the supposed barriers to entry in the 1760s were not as high, and in fact many new banks were formed throughout Scotland, not only in Ayr but also in Aberdeen and Dundee, and these banks, bar the Ayr Bank, survived the crisis fine. The Ayr Bank was simply the biggest and most notorious of these cases. Furthermore, these new establishments, including the Ayr Bank, very quickly became accepted by the chartered bank system in their collegiate note exchange actions, which was an absolute necessity if the paper money of Scotland could be regulated somehow. So the hostility of the chartered banks in Edinburgh was not so high as to prevent this from happening. But beyond there, more crucially, there is actually no evidence whatever that it was the poor asset quality in the Scottish system that caused the problems of 1772. At least not before the post-crisis fire sale of assets by failing banks flooded the land market with collateral and drove down prices. Rather, I have found that the crisis of 1772 was a liability side problem, and it was the special threat to Scottish banks like the Ayr Bank that were overly dependent on the London money markets for their funding. In a manner reminiscent to a more recent case, that of Northern Rock in 2007, which stopped payments exactly because of its inability to refinance its short-term debt. Finally, and more crucially for today's talk, I find that the assertion that the Scottish financial system had no need for a formal lender of last resort because unlimited liability provided the superior alternative to be problematic in mainly two ways. Firstly, the Bank of England in fact did act in a manner very close to that of a lender of last resort, even if the concept itself had another 30 years before Henry Thornton formulated it in his 1808 Paper Credit of Great Britain. The Bank of England, in fact, offered a very substantial bailout loan to the Ayr Bank in June 1772, though this was declined by the Ayr Bank in favor of an ultimately disastrous attempt to tap the private money markets. Beyond the Ayr Bank, the Bank of England intervened rapidly, massively, and deploying a variety of intervention mechanisms not seen for at least another half century. These included direct loans to Scottish institutions, not just the Ayr Bank, but another large financial institution called Alexander Sons. Moreover, 10 direct short-term loans to London bankers, and also very rapidly expanded its discount facility to the wider market. Secondly, when it comes to the supposed lender of last resort by proxy argument, that is, that unlimited liability pooled resources in such a way as to make a lender of last resort redundant, the problem with this mechanism is that it operates in timescales that are much too slow to be a credible crisis containment mechanism. So, for example, although the Ayr Bank eventually paid all its creditors in full because of appeals to the unlimited liability of its shareholders, it also took over 20 years to do that, with some assets still being liquidated half a century later. So it is very hard for me to see how an operation that took so long led to losses